Hey, it's Rick again. Welcome back to Retirement School. One of the questions I get asked most by people getting ready to retire is, do I have to take my money out of my IRA when I turn 70 and a half? It seems like the age 70 and a half thing sticks in everybody's mind, but also the impression with some people anyway that they have to take all their money out is also in there somewhere. So it's, as you probably know, not that bad. But let's talk a little bit about those rules. I'll just sort of give you some basic guidelines, and you can talk more in detail with me depending on your situation. So we call these RMDs, and you'll hear them talked about all the time as your required minimum distributions. And it's the minimum amount, obviously, you must withdraw from your account each year. Generally, you start taking them when you're 70 and a half. There's exceptions like for inherited IRAs and things like that. But what we're talking about in this module is when you turn 70 and a half. And don't forget, Roth IRAs don't have required withdrawals until after you die. So that's one of the advantages of Roths, is that there's no reason to take the money out if you don't have to. You can just let it grow on a tax-deferred and tax-free basis. So you can withdraw more than the minimum amount. All right. So when we say it's the minimum required distribution, that's not, like you can't take any more than that, but you have to at least take it out because it's a 50% tax penalty if you don't. And your withdrawals are taxed. So this was the deal you made with the devil when you set up an IRA or a 401k and rolled it into an IRA, is you got to deduct that money on the front end, but you have to pay taxes on the back. And when you're 70 and a half, then the government wants to start getting their share. So that's why the RMDs exist altogether. Now, I went to the website and copied this directly off irs.gov. You could look it up. You have to start taking them out on April 1st of the year following the calendar year in which you reach 70 and a half. So if you turned 70 and a half at the end of last year and you didn't make your required minimum distribution, you're okay. You can take it out this year, but you'll have to take two out for this year. So we usually say, take them out in the year you turn 70 and a half, or take your first one out in that year. And then every year after that, you have to do it by December 31st. And yes, I have sat in this office while football's on New Year's Eve and been doing distributions that had slipped through the cracks. We don't want that to happen anymore, but yes, you have right up until the very last minute to take them out. So that's it. Every year after you're 70 and a half, you have to make that distribution. During the financial crisis, they waived it. They said for a year or two, as I recall, you didn't have to make your required minimum distributions, but that was a very unusual circumstance. So how do you figure it out? Well, it's based on your life expectancy, right? So every year, your percentage that you have to take out increases slightly because you're getting closer to that end of life expectancy. And so your required distributions will go up a little bit on a percentage basis every year. Please just go find an online calculator or call me. I'll do it for you. Don't try to figure it out by hand. It's cumbersome and doesn't do you any good to figure it out that way. And don't forget, if you're married, you'll need to also enter your spouse's age, especially if you have a younger spouse. That does help you. It lowers the minimum amount you have to take out. So let's look at an example of it. Let's say I have John, who was born on 2/16/47, and his wife was born on 3/1/49. And at the end of last year, they had a $500,000 IRA account balance. Now you have to look at all of your IRAs, and this is an interesting point to bring up, by the way. You can take your minimum distribution from one IRA, as long as you calculate all of your IRAs into the formula that you're going to use. So you don't have to take a little bit from each one. You just have to figure out what your minimum is for all of them, and then you could take it from just one of your IRA accounts. And the number you're looking for is the end of year balance for the year before. So in our example here, we're going back to 12/31/16. And when I enter it into my handy little online calculator, it comes up that his required minimum distribution for the year is $18,248.18. So in our example here, that works out to be what? About 3% of the value of his IRA. So like I say, it's not that big a number to begin with, but if it's 3% this year, it'll be, you know, like 3.5 or 4% next year, and so on. So they do start to add up, which is why we try to do some planning for that ahead of time when we are able to, before you reach 70.5, to try to anticipate some of these changes. And that'll be another module we'll talk about. So that's it. It's pretty simple. A couple of details. Remember, it's taxable income, but and this is the one that not everyone knows, is that you don't have to take cash. So let's say you have shares of an investment in your IRA and you like that investment, you don't really want to sell it. You don't have to. You can take those shares and transfer them in kind to your regular account that isn't part of an IRA. You just have to pay the tax on it, you know, as part of your income for the year. So that's the important thing. And don't miss one of these things, because it's a 50% penalty if you do. So that's it. I hope this helped. It just sort of clears up something that we have to talk about as we go forward. And I got to take Maggie outside. We'll talk to you a little later. Thanks.